Nike lost 77%. Apple's chief executive bought it twice. Here is the fall. In November 2021, Nike closed at $177.51. Today it closed at $40.73. 2 days ago it printed the lowest close of the whole slide. You have to go back to September 2014 to find it this cheap, almost 12 years. And all the way down, 5 of Nike's own directors were buying. 10 purchases, their own money, $8,881,000. Tim Cook, who runs Apple, bought 50,000 shares, then 25,000 more. Elliott Hill, who runs Nike, wrote $1 million check, then he wrote another one. Every single purchase is now underwater. So what is it worth? Not what it costs. What it is worth. I rebuilt every model Wall Street and the great investors actually use. A cash model, peer comparisons, Wall Street's own targets, a screen from 1949, and 10,000 simulated futures. By the end, you get one price and one word. One rule first and then the desk takes over. The models run on today's price, not the price the directors paid. We are valuing the company you can actually buy tomorrow morning. I will be back with a number.
Start with the paper because the paper is the whole story. It is called a Form 4. It is the page an executive must file within 2 days of buying their own company's stock. Name, date, how many shares, what they paid. It goes on a public website the same week. Nobody gets to hide it and nobody gets to add it later. Here is the whole record. 10 open market buys, 5 directors, 16 months. They land in 2 clusters. Late December around $60, then April around $42. They were averaging down hard. Tim Cook paid $58.97, then $42.43. Robert Swan wrote 3 separate $500,000 checks. George and Vig Knudstorp joined the board in September and bought $1 million of it 2 months later. Now the other side because it sits in the same drawer. Insiders sold about $62 million in the same window. Most of that is one man, Mark Parker, selling on a schedule he set up years in advance. That is machinery, not opinion. But the finance chief, Matthew Friend, never bought a single share. He sold 9 days ago at $41.60, and the company itself stopped buying. Nike spent $3 billion on its own shares the year before. Last year it spent $146 million. It paused the whole thing at a 12-year low. So be careful with what a purchase proves. A director sees the plan and the order book. They do not see next year. Directors bought their way down Bear Stearns too, and $1 million is small change to the man who runs Apple. What it does tell you is simple. They looked at the same numbers we are about to look at and they did not flinch. So what are they buying? Shoes, mostly. Nike sold $46.4 billion of product last year. 2/3 of that is footwear. It is made in 95 factories across 11 countries. About half the shoes come out of Vietnam, roughly a quarter out of Indonesia, 16% out of China. The money comes from 4 places. North America is $20 billion and it grew 5%. Europe is 12.5 and it shrank 3 once you take the exchange rate out. Asia and Latin America was flat, and Greater China is $5.8 billion, down 13. Hold that one. It matters more than anything else on this board. And plenty of this is still very good. 43 cents of every sales dollar is gross profit. Gross profit just means what is left after paying to make the shoe. Nike holds more cash and investments than it owes. It has raised its dividend for 24 years in a row. The shares now pay you 4% a year just to hold them. Now the crack, and it is a wide one. China has fallen for 8 quarters running. Sales there are down 30% since 2021. The profit is down 61%. It fell twice as fast as the sales did. Converse, which Nike also owns, made $543 million of profit in 2021. Last year it made $18 million. And Nike's own website sold 12% less, which it's filing blames on lower traffic. Time for the models. First, is it cheap? Nike costs about 19 years of its profit. That sounds cheap. It is not what it looks like. 52 cents of last year's $2.10 came from a tariff refund, not from selling shoes. Take that back out and you're paying 26 years. Against sales, though, it really is cheap. Nike has not been this low against its own sales in 10 years. So put it beside its rivals. Adidas, the owner of Hoka, On, Lululemon, Puma. The middle of them is worth about 1.25 times a year of sales. Nike is on 1 3/10. It has been marked down all the way to average. That gives $40.38. Rung 1 lands almost exactly on today's price. Rung 2 does the same thing on profits. Those rivals pay about 9 times a year of cash profit. Apply that to Nike and you get $29.38, and there is a real-world check on this one. Last year, a buyer took Skechers private for cash. They paid about 10 times profit. Nike is on nearly 13. Rung 3 is the one every bank builds. Think of Nike as a machine that prints spare cash. Spare cash is what is left once it has paid for everything, including new shops and new factories. Last year, that machine printed $2.2 billion. 2 years ago, it printed 6.6, so we were generous with it. We told the model the cash grows 12% a year, then slowly slows down. The answer is $35.66. Below today's price, even being kind to it. Now the people who are paid to decide. 39 analysts cover this stock. Their average target is $50.66 and they rate it hold. 4 months ago, that average was $63.64. They cut it by a fifth while the stock made a 12-year low. Jefferies is the most hopeful at 75. BNP Paribas is the most brutal at 23. And all 4 of America's biggest banks now say neutral or worse. Now the great investors. Benjamin Graham published a screen in 1949. Take the earnings, take the book value, which is what would be left if you sold everything the company owns and paid off everyone it owes. Multiply the 2 times 22.5 and take the square root. It was built for factories with machines in them. Nike has factories. The answer is $21.76. Peter Lynch's rule was simpler. A fair price counted in years of profit is roughly the growth rate. So what is Nike's growth rate? In 2019, it earned $2.49 a share. Last year, $2.10. It has gone backwards for 7 years. The rule needs a growth rate and there is not one, so it gives no price at all. That refusal is the loudest thing on this board. And now the best question in this whole business. Stop asking what it is worth. Ask what today's price already assumes. Run that cash machine backwards from 40.73. It needs the spare cash to grow about 15% a year every year for a decade. Last year it fell 33%, so the market is not pricing a dying company, it is pricing a full recovery. Which brings us to the machine. Instead of predicting one future, it rolls the dice on 10,000 of them. Some where the running shoes win China back, some where they never do, some where the tariff money gets taken away again. Every roll prices the stock. Stack 10,000 answers and you do not get a guess, you get the shape of the future. Here is what is in the dice and none of it is invented. How fast the cash comes back, where the profit settles, what money costs, and what Nike turns into when this is over. Then 4 named shocks, each one out of Nike's own filings. China's shop partners get cut off in January. The tariff money gets clawed back. Rebuilding the wholesale business keeps costing margin, and the classic sneakers keep shrinking. 10,000 futures. One fixed seed so anyone can run it again, every input a public number. The middle answer is 36.52. 41% of those futures land above today's price, but look at the width. The middle 90% run from $16 to $88. So what would actually move it? 4 things, and you can watch all 4. Whether the spare cash climbs back toward what it used to be, whether China stops falling, whether the tariff money stays, and interest rates which quietly reprice every number on this board. Quick, honest ask. We are a brand new channel and subscribing is how we know you want more of this. That is the whole ask. One more and it is a stress test, not a prediction. We took the worst crashes in market history and asked one question. If it happened here, where would the maths land? Microsoft's path gives 65.68. Nike has already fallen further than that. The whole Nasdaq's path gives 39.05. Nike is sitting 2% above it. Intel's gives 31.95. Cisco's gives 24.85. Now the floor underneath. Take the earnings without the tariff refund, $1.58 a share. Pay the cheapest price the market has given Nike in 10 years, about 18 years of profit. Add the cash. You get $28.70. So the panic maths and the earnings maths finally agree on something. Most of the fall has already happened.
So, 8 models, 1 company, 1 night. The lowest said $21.76. The highest said $50.66. And one of them refused to answer at all. Take the 5 that vote, and the middle of them is $36.52. Today's price is $40.73, 10% apart. So the models say fairly priced, which is the uncomfortable answer. Not a bargain, not a disaster. If anything, still slightly dear after a 77% fall. And here's the part that stays with me. Every director who bought is underwater. They paid $53.25 on average. It is $40.73 tonight. They were early or they were wrong, and nobody will know which for years. None of this is financial advice. These are deep models built on public numbers, and every model on this board has been wrong before. That is exactly why we run all of them. Which stock goes on the table next? Tell me.